In the 34th lesson in the course of Critical History of Economic Theory and Policy, we continue to examine the record of the Clinton administration during his second term as President of the United States. The lesson not yet learned by elected leaders and their economic advisors was the destructive power of poorly regulated, credit-fueled property markets. Speculators had taken over the game, subverted whatever rules remained, and used their financial gains to secure political support. Manufacturing output by companies operated in the United States was rapidly increasing as new technologies were adopted, yet employment growth came from non-manufacturing sectors of the economy: government, nonprofits, services, and the fire players: finance, insurance, and real estate. The Federal Reserve Board decided to leave the discount rate alone and allow investors to continue to invest, essentially not paying attention to the flow of funds into land markets and other wholly speculative activities. Greenspan later stood behind this decision. By not being too quick to raise rates, we helped clear the way for the post-war period's longest economic boom. This was a classic example of why you can't just decide monetary policy based on an econometric model. So much money was being invested in the stock market by investors worldwide that the momentary valuation of stocks at the end of 1996 was around $9.5 trillion, a 60% increase from just 1990. The Dow Jones Industrial Average had broken the 6,000 mark for the first time ever. The capitalization of all stocks worldwide had climbed to $20 trillion with no signs of a correction. Early in 1997, the Dow surged towards 7,000, and a growing number of economists began to write about a probable stock market bubble and to call for the Federal Reserve to take action. In 2002, John Macon of the American Enterprise Institute offered his analysis of the events and what caused the turmoil that erupted. He wrote, "A close look at the role of governments in markets during the last half of the 1990s suggests that the Fed's role in creating preconditions for a stock market bubble was at most peripheral, and that the Fed did undertake to cool an overheating economy in 1999. The fact that equity risk premiums, the expected higher total return on stocks above returns on riskless government bonds, were falling sharply while the U.S. equity market bubble was inflating, suggests that the real contributor to the global bubble was the proactive role of policymakers in rescuing markets from the fallout of the Asian bubble in 1997-1998, including the long-term capital management crisis in October 1998. While the Fed played a subordinate role in all of these events, the proactive role of the U.S. Treasury and the International Monetary Fund was more decisive in creating a moral hazard problem that led global financial markets first to be shocked and then driven from risk exposure by the Russian default and devaluation in August 1998, and then to be overly inured to risk after the rescue of long-term capital management in October 1998. At the same time, a growing list of governments that had borrowed extensively from U.S. banks were finding it difficult to meet repayment obligations. When South Korea was added to the list, the World Bank and International Monetary Fund acted to impose their typical economic reforms on these governments. Then, less than a year later, the Russian government announced it could not repay its dollar-denominated debt. A major reason was a drop in oil prices to just $11 per barrel. The Russians refused to abide by IMF terms for new loans, soon ran out of dollar reserves, and late in August of 1998 ended efforts to prop up the ruble against the dollar. The ruble fell sharply, and trade in the currency had to be suspended, as it lost some 40% of its value against the German mark. Wall Street investors orchestrated a massive sell-off, and the Dow fell by over 1,000 points. Peter Coy, a market analyst at Businessweek, noted in November of 1997 that long-accepted market theory no longer, if it ever did, describe how markets actually work. With the toppling of efficient markets theory from its place of dominance, academics are harking back to earlier thinkers such as John Maynard Keynes, who said in the 1930s that bubbles can form and burst because investors focus on one another instead of on the fundamentals. Wrote Keynes, "It is not a case of choosing those which, to the best of one's judgment, are really the prettiest, nor even those which average opinion genuinely thinks the prettiest. We have reached the third degree where we devote our intelligence to anticipating what average opinion expects the average opinion to be." Keynes's description of the stock market as a beauty contest is a progenitor of Alan Greenspan's warning against irrational exuberance. The message: you can't always trust the stock market to get things right. Then perhaps the most controversial change in law occurred with passage of the Financial Services Modernization Act, which overturned the Glass-Steagall Act. No longer would there be restrictions on the investment activities of commercial banks, investment banks, and insurance firms. As the 1990s drew to a close, millions of households were struggling with burdensome housing expenses. The number of working families with severe housing burdens, those spending more than 50% of their income on housing, grew dramatically in the late 90s. From 1997 to 2001, that number increased by nearly 60%, jumping from 3 million to nearly 5 million working families. Living costs, including costs of health care, were already increasing at a rate driving working families into poverty. Real incomes for low and moderate income families were stagnant or declining. Household incomes for the bottom 40% of the income distribution declined between 2000 and 2001. In mid-1999, Alan Greenspan directed the Federal Reserve banks to pursue a deliberate policy to drive up interest rates, knowing this would curtail business borrowing and cause a rise in unemployment. The objective was to undermine workers' demands for substantial wage and benefit improvements. Greenspan argued, strong demand for labor has continued to reduce the pool of available workers. Data showing the percent of the relevant population who are not at work but would like a job are around the low for this series, which started in 1970. Greenspan offered no comment on the number of workers who were underemployed, who had experienced net losses in overall compensation, or who were working at more than one job in order to make ends meet. A closer look at the official unemployment figures indicated the economy was experiencing a labor shortage only if one ignored numerous other factors. In many regions of the nation, underemployment meant that a significant number of households were struggling to meet basic living costs. The U.S. government was also struggling to raise needed revenue. The national debt increased during the Clinton presidency by over $1 trillion. Servicing the entire debt absorbed $330 billion in 1995 and more each year thereafter. The Clinton picture of prosperity clouded over as 1999 advanced. Between March and December, The Nasdaq declined by 50%. Rising oil prices were placing an increasing drag on the economy. Cracks were also appearing in the financial services sector after a decade of mergers and acquisitions, one result of which was to eliminate employment for hundreds of thousands of workers, including many well-compensated management and technical workers. By 1999, many banks were reporting rising delinquencies and were forced to take significant loan losses. And as noted in this chart, serious delinquencies started earlier and were substantially higher among subprime adjustable rate loans compared with other loan types. Chase Manhattan Corp. And J.P. Morgan and Company announced their merger, indicating 5,000 positions would be eliminated. Fleet Bank acquired Bank Boston. And the analysts at Business Week were forecasting the worst is yet to come. Robert Kuttner, who studied at the University of California at Berkeley and at the London School of Economics, was one of a small number of economists who expressed serious concern over unfolding trends. Kuttner wrote, "The Federal Reserve now encourages such consolidations. The Fed's chairman, Alan Greenspan, believes that American megabanks are necessary for safety, efficiency, and global competitiveness. In Greenspan's view, there is a place for small community-oriented banks and a place for big global ones." Nearly 10 million people worked full-time year-round but for less than $7 an hour. These two groups of workers, all of them counted as employed, amounted to double the 7 million workers who held no job and were classified as unemployed. Thus, the total unemployed and underemployed workers was over 21 million. Robert Reich, who served as Secretary of Labor in the Clinton administration, was interviewed in July of 1995 on the condition of working people in the United States. He admitted he had no good answers. "We don't know very much why it's happening. All we know is that it seems to be a continuation of a long-term deterioration in the wage structure of this country and a widening gap between people at the top and everybody else." People at the top have two big advantages in this new economy. First, they have the education and skills necessary to take advantage of modern technology and global markets. Second, they own financial assets. The value of financial assets has been increasing markedly. Together, those factors have created enormous wealth at the top. Let me be clear about this. The problem is not that some people are getting rich. We should celebrate the fact that some people are getting rich. The problem is that, for the first time in the post-Cold War era, everybody is not gaining as the economy grows. In fact, many people are losing ground. Alan Greenspan was not the only one at the Federal Reserve anxious about the direction of the economy and desperate for a reliable understanding of business cycles. In June of 1998, the Federal Reserve Bank of Boston brought economists Paul Samuelson, Peter Tiemann, Christina Romer, Benjamin Friedman, and others together to share the results of their research. Introducing the published conference proceedings, Fed President Cathy Minahan explained the importance of this exchange. Our inability to pin down the source of the most important events in economic history seems to me a gaping hole in the intellectual underpinnings of modern macroeconomics. Not one of the economists involved in this conference referred to skyrocketing property markets or the land component as a primary driver of business cycles. Had they read Fred Harrison's 1983 book, The Power in the Land, they would have had a far better perspective on the problems. As the United States braced for yet another period of economic chaos, University of California professor Maurice Obstfeld offered this discouraging global perspective. The stakes are extraordinarily high, but the easy answers are few, in effect. Policy must counteract the severe capital account shocks by creating a new expectational climate, and economics has little to say as to how this can be done, short of infeasibly extensive official financial support from abroad. Fiscal expansion would seem to carry minimal risks given the generally sound public finances of these countries in the past. Reality was to prove quite different from what government statisticians were reporting. The Federal Reserve was actually beginning to plan for the possibility that the U.S. government debt would be repaid. Remarkable as this sounds in 2019, as the public debt climbs toward $30 trillion.